Let me show you something interesting. Over the last 18 months, I invested slightly over $10,000 into the stock market. Not all at once, $100 a week for the first 6 months, $130 a week for the following year. And now my portfolio is worth about 15% more than that. That might sound decent, but here's the strange part. That happened despite two major drops during that time. One when new tariffs shook the market and stocks dropped sharply. Another one when geopolitical tensions raised again. So the obvious question is, how can the portfolio still be up after all that? And the answer is actually more interesting than the number itself. Hi, my name is Mike, and on this channel I'm showing you how a regular person with a really boring strategy beats S&P 500 index. Let's go! At the first glance, it looks simple. I invested $10,000, now the portfolio worth $11,500, so the gain is roughly 15%. Sounds straightforward. But there is a catch. This isn't actually the performance of the portfolio. This is something a lot of new investors misinterpret. I'll show you what I mean. I didn't invest $10,000 all at once. I invested gradually. Some money went in September 2024, some in January 2025, some in July 2025, and some literally today. So those dollars had very different amounts of time to grow. Which means the simple formula, portfolio value divided by total invested, doesn't really tell the whole story. Because a dollar invested 18 months ago worked much harder than the dollar invested last week. If you actually look at the performance of the investments themselves, the picture looks very different. I kept track of the portfolio growth every time I was about to add more money, and the portfolio performance is about 37%. Not 15, 37. And here is what makes it even more interesting. During those 18 months, the market wasn't smooth at all. It had two big drops, one because of tariffs, another one because of war. Both times the market fell. Both times my portfolio dropped too. But there is another reason why my portfolio held relatively well. Diversification. When people say the market is down, most of the times they actually mean the American market. Or sometimes they mean S&P 500 index. But my portfolio isn't just the S&P 500. About 50% of it is in American companies through VFV and ZNQ. But another 25% is VTY, the Canadian blue-chip companies that also pay decent dividends. And the rest is international exposure through VIU, developed countries beyond North America, and VEE, developing countries like China, India or Brazil. So when the US market drops, it doesn't hit my portfolio equally. Some parts fall more, some parts fall less. Some parts don't fall at all. And during both market drops, I kept doing the same thing. I kept investing. That is the strange thing about long-term investing. The scary moments that make people stop investing are the same moments that quietly improve your future returns. Because every drop means the next time you buy a share, it is on sale. And later, when the market recovers, those shares grow more than if the market didn't drop. Do you know what the most important part is? This result didn't come from timing the market. It didn't come from predicting the market drops. It didn't come from picking the right stock. It came from something much less exciting. Consistency. Just showing up, week after week, and letting time do its job. If you're building your portfolio the same way, I'm curious, how long have you been investing? And what has been your experience so far? Let me know in the comments below, and I'll see you in the next one.